with our next guest. Ross Gerber is the president and CEO of Gerber Kawasaki Wealth and Investment Management, joining us this afternoon. Ross, great to have you on the program. Looking at this market right now, as Victor pointed out, a lot of things that dropped into correction mode, showing a little strength here. Is that the valuation pullback that investors like yourselves maybe were looking for?
Yeah, absolutely. You know, for the first time, we can look at stocks and actually find bargains. And, you know, as we went into January, we were very concerned about the rally getting overdone. So this is very healthy and a normal part of markets. And you know, a little fear creeps in and creates opportunity. But with the numbers we expect for Q1 earnings, it's hard not to be a bull. I mean, it really is.
You know, Ross, let's talk about that, because I'm fascinated with this as well, because we were all talking about that 200 DMA, and I've latched on to the fact that if you just do the simple math based on the forward expectations for earnings, which is about 150 to 160 bucks, depending on where you go, puts that 2588 on the S&P at a 16.5 forward PE, which is right at the 30-year average. Now, the trailing's a different story. It's a little bit more expensive, but does that mean we've got a high bar to reach in the next quarter, Ross?
Well, I mean, we do have high expectations, but I think we're going to see really good numbers. I mean, we've never had a tax situation for corporations like we do today. And with a strong economy and good earnings without tax reform, I mean, nobody, I think, on the analyst community has earnings right here. And I think it's going to surprise on the upside even.
So, okay, that's interesting, Ross. So you're saying, look, the risk here might actually be that we didn't price in enough coming from some of this stimulative effect from taxes.
You know, as much as Trump is trying to hurt the economy with his dumb tweets, it's not going to change that people have turned it off and they're going out and they're spending money. They're traveling. The restaurants are packed. You know, Coachella's in 2 weeks. It's sold out. You know, I mean, you know, the economy's great. And so, you know, you have to look at the underlying fundamentals of what we have going on here, and at least be happy that corporations have as much cash and capital to use as they've ever had.
Yeah, Ross, we had a great conversation this morning on Morning Trade Live with Ben Carlson about the sort of division that can happen between the economy and the market, right? Where you can have a strong economy, but yet a bear market can't happen. Valuations get extended for various reasons. When will we know if what we're seeing here can become that type of environment where even though the economy is strong, do markets have to give up more? Will earnings season tell us if that is the case?
I don't necessarily agree with that. You know, we've never actually seen a real bad bear market without a recession. So, you know, what we look at is there a risk of a recession this year, and which we see very, very little risk, especially with government stimulus and ultimately still low rates. But as we get into 2019, I think the risk increases a lot because of the Fed. And of course, our government policies that are somewhat regressive at this point. So right now, it looks really good in front of us on the short and medium term. And I do have a decent amount of worry on the long term. But we're estimating up to, $160 on the S&P. And we're looking at a forward PE of 16. And that's a market with higher earnings I'll buy anytime.
Okay, so we're looking at this look right now, which is that earnings expectation, right? I guess what some would say then, Ross, to sort of harp on this a little bit more, because I think it's so important given just how quickly those analyst expectations ramped up. Even if you say, listen, they need to be ramped up more, that's one point. The other, you might look at it and say, hey, these things moved up so quickly that some call that being priced to perfection. But it sounds like you disagree with that description of where analysts expect things to go.
Yeah, you know, if you watch me over time, you'll see that I don't have a lot of credence in what analysts do, because they're almost always wrong. So, you know, when analysts get numbers right, I'll start paying attention to it more. But the fact of the matter is that everybody's working in a sort of, you know, behind the curve system of, we'll upgrade after we know the news, you know. So I think if you look at a company like Disney today, trading at the multiple it's trading at, with the amount of earnings they've had with Black Panther and other wonderful catalysts to their business right now, I mean, it just looks like an awesome opportunity to get into some high quality names during this correction right now. We have fair value at more like 2750 on the S&P, so that implies some nice upside.
Hey, Ross, one point about the economy versus the market, because I hear this crop up a lot, is things get rough, right? We see this bout of volatility, and when you talk about the fundamental story, which I think to your point is very hard to deny, right? Last week, it seemed like nobody was talking about the string of economic data that pretty much hit it on the mark.
Right.
But then they point out a year like 1998, where things seem on the up and up for corporate earnings, economy, but then you have some existential risks, many of which some will compare to today's geopolitics and trade, and they say, look, you might get a drop. What will tell us if that existential risk becomes something that is hard to manage from an investment perspective?
Well, fortunately, I was trading as a professional in '98, and that was, during an Asian currency rout that happened, and it caused a lot of uncertainty. We had a quick 20% decline, but then rise in the markets. Of course, the risk is so elevated with the current political situation. I mean, every day there's a certain level of uncertainty, but what we consider the biggest risk to the market is political risk, is our own government. That's the irony of the situation. As good as the economy is, it's a self-created crisis that could happen, and it really could happen at any time. So, we're running our portfolios pretty conservative, to be honest. We're aggressive on the stock side, but on an allocation basis, we're playing very conservatively right now.
Ross, final point here, because I'm curious about that. When you talk about the allocation side, does that mean putting a little bit more money outside of the stock market in general, bonds? What to you will kind of hedge that risk that you talk about?
Well, one of the things we've done is we've looked at alternative investments that hedge against rising rates, because obviously we run just a traditional, let's say 65, 35, and 35 in bonds. That does expose us to downside with rates in a strong economy. So we've used a lot of hedge investment products to try to get some, offset to a rising rate environment. We're looking at alternative assets. Inflationary assets are attractive because we do think Trump is very inflationary. So things like gold actually have entered our portfolios for the first time in a long time. And so we're looking at inflationary assets as a hedge, and of course the XLF against higher rates. But we're running still at least 25 to 30% in bonds.
Yeah. All right, Ross. Hey, great analysis here and a great frank conversation as investors try to figure out where we are in this market right now. Pleasure to have you on this afternoon. Ross Gerber, President and CEO of Gerber Kawasaki Wealth Investment Management.